Hi everyone. So far we've covered how options payoffs work, the sensitivities. We've covered how to build a portfolio with allocations. We've covered how signals work, and we've covered also how what are the risks, what are the exposures, and what are the signals that drive your stock price short term and long term. And so in this video, we're going to cover another part, which is valuation. So very quick about me again, I've worked as a trader, but also as a portfolio manager. And I was also a quant analyzing hedge funds portfolios. So I can not only understand short term, what drives the market short term and short term strategies, but also long term. So like everything around portfolio management and valuation. And I can also help you build the optimal portfolio and understand what's driving your profits. And so in this part, we're going to cover the valuation part, how to pick the best spaceship. All right. So this has more to do with the CFA. So I took the CFA. This is more like CFA level 1. CFA level 2 is like very easy things about options and etc. But so this part is about valuation. All right. So price is what you pay, value is what you get. This is a very famous quote from Warren Buffett. Warren Buffett is a value investor. So the idea is that he tries to assess the value of the company, and then he ignores short-term moves. But he has some traders who are going to take care of it and how to reduce market impact of his portfolio and everything. And so he's going to buy and hold. Okay, DCA, hold. And so the first thing you have to understand when it comes to valuation is that you have to compare a company with its peers. All right, so you're not going to compare a company that's selling water with a company that's sending rockets to space. And maybe you like one more than the other one, etc. But you have to understand that the first thing is the market segmentation. And this, you have it when you play a video game, okay? So when you play Mario Kart, you have some light cards, some medium cards, and some heavy cards, all right? And each one is okay. All you have to understand is what's the difference. Light cards have quick acceleration, heavy cards have a slow acceleration. Light cards, they get kicked easily. Heavy cards, they kick others. So basically, they all have some pros and some cons. And you build a portfolio based on your goals, all right? And same with valuation. When you want to understand the value of a company, you have to compare it with its peers. So this comes to understanding the style, okay? So value versus growth, but also understanding the industry, okay? So like you're not going to compare an energy stock with a finance stock. You have to, you can do it, okay? And this is another thing, but when it comes just to finding the best stock, you want to compare only with the peers, okay? And same thing, you have also size, you know, like a small cap versus a large cap. They all have some pros and cons, and they are totally different. Now, when we send you a signal, so this was a signal for NVIDIA, you can see the segmentation, okay? It's the industry part. You see here semiconductors, you see the valuation, okay? So you know if it's a small cap or large cap. Now it's 4 trillion, this one, I made these slides a while ago. And something else that's important is the ownership, okay? So of course, an institutional stock has nothing to do with a retail stock, okay? NVIDIA is owned by both, but sometimes you see some stocks that are heavily owned by retail, some only by institutions, like MSCI, it's mostly institutions. Retail doesn't even know about it, and it's been doing great, you know, like, but it's less volatile. Anyways, and then the segmentation, we also add the indexation. So if it belongs to the S&P 500, you will see it directly in the signal. Okay. Now, just to cover this part a bit more, when we send the signal, you can see when you should buy it. Okay, and it's okay to get a bit late. Just ask me on the feed if you want. How much to buy, because you're building a portfolio. Again, you're not going to put 100% on the signal. And when to sell, and same thing here, based on the strategy, you can either sell right away because it's like a short-term strategy and you have to sell it quick, or you can keep DCA and sell slowly after the target sell date, okay? So here you can DCA after the target sell date. Anyways, this is just about the signal, but market segmentation, you can see it, and this we've covered it already in the previous videos. You can see it, you can see the industries, you can see the metrics tab, which stock belongs to each industry. You can check the industry, see which stocks belong to it, etc. You have the same thing with style, and same thing if you pick a stock, you go in the macros, you see the industry. Okay, so here NVIDIA, you see it's technology sector, and you can compare the performance of NVIDIA with the performance of its peers. So this is for the segmentation. Now we want to cover the metrics. How do you know the value of the company? Okay, so we said you compare it with the competitors and the peers, but you want to value it. That's the next part. And we're going to, the first thing to look at is the financial metrics. And this is how things work. Okay, so I'm going to cover in this part now the financial metrics. But just before we go forward, I want you to look at this graph and understand that you have the market price, okay? It's what we saw about the signals, what drives interest short term and what drives alpha and value long term, okay? It could be like hedge fund trades, etc. We saw all the exposures, all the risks, even if it's not just a risk, because a risk can mean money also. Anyways, and you have the value, and this is what we're going to look at now. And this value, it's something that's supposed to be fair, but the real stock price, the stock price is not the value. The stock price is the demand. It's the volume. It's the interest, and the stock price it's supposed to oscillate around the value. Okay, and an investor like Warren Buffett, he wants to buy the value when the stock price is under the value. Okay, like this makes total sense. And the idea is that you try to assess the company, pick the best one, if not the best, at least one that's undervalued, etc. Okay, so what's the value? The first thing you can look at is revenues. Okay, so revenues, everyone knows what it is. It's how much money they make. Okay, so like you sell ice creams, you get paid. You see how much ice creams you sold over a month, and that's revenues. And for Mario Kart, it's basically the mushroom that you take, and it boosts you like crazy. The more revenues you have, the more boost you get. Okay. But then you have to think in terms of profitability. And so, like any company, you have costs. And what's very relevant, at least for large companies, but again, we're going to see why, is net income and earnings per share. Okay, net income is the net profit, and earnings per share is the profit per share, because each company has a lot of shares. So how much profit you get for one share that you buy. And this is like the star. It's something very powerful, because the revenues, you can be big, but if you're not profitable and not making a lot of money, it's hard to grow more. When you're very profitable, you have so much cash, you can do anything. You can pay investors, you can launch new projects, you can sit on cash just in case, etc. Then you have price to earnings and price to sales. This helps you assess whether the stock is expensive or not. Okay, so price to earnings, you compare the stock price to the earnings, so the net income. The price to sales, you compare the stock price to the revenues, the gross income. Okay, so PE is more about profitability, comparing the stock price with this profitability, and PS is more about comparing the stock price with the revenues, with how big it can generate, how much money it can generate. And both matter because small companies in the beginning, they're not profitable. They spend their money on growth, and they're not profitable. So small companies are not going to look at PE. It makes no sense to look at PE for a small company. Okay, then you have short interest. Short interest is how much people believe the stock is overvalued. So when short interest is high, it means there are a lot of people who are against it. Okay, it can be a good thing and a bad thing. Again, we're going to cover it, but this is like the bomb. So if you see a high short interest, most likely careful, don't come unless you understand there is very high risk. And then you have ownership data. So ownership data is who is holding it. You know, like if it's Mario or if it's Donkey Kong, you're not going to have the same kind of risks. Okay, like Mario maybe is safer. A browser maybe he likes to explode and stuff. And so, so ownership data matters. We're going to look at it. And then you have a lot of things around how solid is the company, not only revenues, because here if you look at it, we covered mostly income, but you have also balance sheets. So what are the assets, liabilities, what are their debts, what do they own, and things like this. Because in the end, if they have if they own a lot of things, they can always sell them and make money out of it. You know, like things like this. Anyways. So it's not only about revenues, it's also about assets. MSTR, MicroStrategy, they have no revenues, but they have a lot of Bitcoin. And that's what's driving the valuation, etc., etc. And so what we said is revenues is how much it could grow, because it's scalability, like how big they are. Net income and EPS is profitability. PE and PS, it's whether it's overvalued or undervalued with respect, if the stock price is overvalued or undervalued with respect to its profitability or to its revenues. Short interest is how much downside, ownership data, who owns it, and the rest, we're not going to look at it for now because it's subtleties. You're not going to, we can spend hours looking into it and talk about it later, but for now, let's just cover this, it's more than enough. Now, all these metrics are explained in the app. There's an onboarding that explains how to use everything. I'm covering it in a video because maybe it's a nicer format. And I will do more, and we will even do some live streams and everything. But let's go on for now. And so this is what we said. We said now you have the metrics that you want to look at. But now you need to assess whether it's overvalued or undervalued. Okay? And so, again, I want you to understand that short term, it's the volume that drives the stock price. Long term is the valuation, but it's not only the valuation, it's also the growth, okay? So you can have value traps, which are stocks that are undervalued, but they have no growth, okay? So if there is no growth, nobody cares about this stock, even if it's undervalued, because people often, some people care, so it's value investors, but often people, they want to see things go up. They want growth. They want to see that there is a lot of great future prospects and that the company is going to nail it, okay? And so high growth can be great, and it will look sometimes like it's overvalued. But the thing is that you need to take into account that the company keeps growing fast. So market participants, hedge funds, investors, traders, they understand that there is more to come, and they price it now, okay? So let's look at the first part, sorry. Peers, before even looking at it, let's just look at NVIDIA versus revenues, okay? So here, NVIDIA, you can see the stock price going up, but you can see revenues are going up as well, okay? It's growing at a nice steady pace. Look, it keeps going at the same pace. And so here, the stock price might look a bit overvalued because in blue here, you have the valuation of the company. In green, the stock price, okay? The stock price is going to go up, okay, before the valuation actually increases. Here, the blue is bigger. Why? Because they're pricing in the growth, okay? And this matters in terms of valuation because we're going to talk about valuation, so sure, but the growth matters as well. So now you look at NVIDIA, you look at, so we looked at revenues, you can also look at net income and EPS, okay? And here you see, like, look, anyone who tells me NVIDIA is overvalued, it went up, like, I'm sorry, but the profitability went up, the revenues went up, like, of course it's going up. It's not overpriced, it's just making money and going up. It's super fairly priced. In fact, maybe it's even undervalued. And maybe now it's more undervalued. Why? Because people are scared of buying, but actually it's better stock than it used to be 5 years ago. I'm going to show you. So this is about net income and EPS. So short businesses have cost, etc. I've covered it very quick. You can read. Palantir is going up as well. But see here, it looks like it's going even faster. And I'm going to show you why. Because revenues, okay, are going up, but the magic is that now it's super profitable. Before it was not profitable. Okay, they were trying to scale. Now it's going up faster, it's profitable, and on top of that, you have a lot of new contracts coming. And why it's going up so fast? Because when you see this, you understand that there is a moat. Okay, Palantir, the guys, they are stealing the contracts from LMT. Okay, the guys who work for Palantir, they are insiders in the government. Okay, so you have the insiders in terms of sales who are stealing the contracts. This is a super strong moat, like you can't do better than that. Like all the contracts go to them. And then you have the moat in terms of AI. So they have a tech moat, and a sales moat. And it's priced in. Okay, it's getting priced in. The growth is priced in. Okay, so that's why it's going up. Look at NVIDIA, it's going up, but the price to earnings. So now we look at price to earnings. Before we looked at revenues, profitability, revenues, net income. Now we look at price to earnings. This is a ratio of the stock price to the profitability of the company, to its net income, the earnings. Price to earnings ratio, when it goes down, it means it's more undervalued. Okay, look at Nvidia. If here I'm not showing you, but the growth is not changing. You saw the revenue growth. It's the same, steady over time. And the expectations are the same. It didn't go down, but the PE is going down. Okay, what does it mean? It means it's undervalued. Okay, because the growth is the same, but the price to earnings is going down. It's cheaper to buy one stock. The price is cheaper than what the company generates. So here you have to look at this P. And if you look at short interest, okay, now another metric, short interest. Short interest is how much downside can a stock have, okay? How much pressure on the downside people want to short. If you look at Adobe, I'm taking another one because it's a nicer example, you can see that when the stock price goes down, there is less short. Now the short interest is 1.9. Above 3, usually it means very careful because it's going to go down. But you can also have some short squeezes and things like this, so like it's a bit more complicated. But the short interest, when it goes up, see like when Adobe was all-time high, you could see it go up. Usually as soon as it's close to after 2.5, you want to be careful. It means maybe something is coming. Okay, so this gives you an indication. So you have to look at short ratio. Every time I do an analysis, you tell me, Anas, I want to know if this stock is overvalued or not. First thing, you look at the signals, okay, short term, long term, what's driving. This is what you covered in other videos. And then you have to look at this. You have to look at all of this, revenues, net income, short PE, PS, short ratio. You have to look at it. And short ratio, the difference is that revenues, net income, etc., it's released every quarter during the earnings. Okay, so the companies, they say what happened over the last quarter. Short ratio is released not by the company, but by the stock exchange every 2 weeks. Okay, so you have much more data points. Then you have to look at ownership also. Okay, so a lot of strategies differ based on whether it's insiders, institutions, or retail, or whether it's shorted or not. The 3 things you usually look the most at is the short, and then institutions versus retail. Okay. And so this is important, you have to understand. And then all the other financial metrics, we can cover them now, okay? But it's going to give you a headache. I'm just trying to make it quick. If you have questions, please ask them, and then we can reiterate. But for now, just with this, just with revenues, net income, etc., you're done, okay? Just with revenues, okay? So every time you want to assess a company, first thing you check is what happened, the signals we discussed before, hedge fund trades, CEO, corporate actions, etc. What happened recently that moved the price to understand whether it's a good time to enter or not. Okay, based on all the other videos we've covered. And then for long term, okay, so you have the short term, you have to enter it well because you're going to cry. I see people, they think, oh, it's undervalued, but if you don't time your thing, you're going to lose trust. You're going to sell after 2 days. And you're not going to hold because you're going to think this is not working. So you have to understand the short term first and then the long term. Okay, you can do both. You can just DCA and buy what's undervalued. And you have to check this: revenues, net income, PE, PS, short interest, ownership data, and the rest doesn't matter as much. Okay, but check revenues, net income. This is how much money they make. Check the growth. Check whether it's undervalued or overvalued based on P and PS. But remember, you have to take into account the growth. Check whether people are shorting it or not. If they're shorting it, careful. Maybe you can wait and enter later. And check who is holding it. If it's institutions, mostly you're most likely safe to enter right away. If it's a lot of retail, maybe you want to wait. Okay? Based on the other signals. And all of this depends on your segment. Okay, so right now I'm just showed you some stocks randomly and how things are moving, but you don't understand what's next. Is it good or not? It's going up, okay, but could it go up faster or not? The PE is lower than before, okay, but what about the competitors? Is their PE lower or not? Some industries like tech have high PE, okay? Some industries like water have low PE because selling water has no future prospects, okay? The only one is inflation. Okay, obviously water is important, but you got the idea. And so now we talked about the segmentation, we talked about the financial metrics. Now we want to talk about comparing the same time series, the same growth, the same revenue change over time, but with the competitors. Not only revenues, but also PE. Okay? So the first thing you can do is compare with the biggest competitor. Okay? Because this is easy. Basically, it means any stock you have in mind, before you buy it, I want you to check whether it's better or not than the biggest competitor. So you search for your stock. Okay, let's say AMD. I search for AMD. I select it. I tap compare. Okay, here. And then boom, I sort by valuation. Okay, on top. And I see the first one is NVIDIA. Okay, so let's compare AMD against NVIDIA. AMD in blue, NVIDIA in orange. Oh my God, NVIDIA went up a lot. Let's buy AMD. But look at revenues. Look at revenues. NVIDIA revenues are going up like crazy. AMD didn't change. How can you expect AMD even to change in 2 years if for the past 5 years there was no change? There is a problem inside the company. Okay, NVIDIA has a moat, and they showed it. They have a moat. They have something, either the tech or the sales or something that's driving growth in NVIDIA because it's a better company. And this growth has been going on for years. Okay, it's going to keep going up. Okay, there is no magic. Maybe it's going to go down a bit, etc. But they have a moat. AMD, they haven't showed any moat. So okay, buy it when there is a short-term signal. I'm not saying it's not going to go up, but in 10 years, you can't expect AMD to beat NVIDIA. Look at this. Look at this. So stop. And this, I've said it like 3 years ago. Huh? 2, 3 years ago, I was already showing the same graph. Okay. Actually, the beginning. So like 2 years ago, I was even doing some streams. Alessandro was watching, and I was showing him this graph. Anyways, so let's go on. And so yeah, NVIDIA looks better than AMD. Okay. NVIDIA has a moat. Now EPS same thing. Okay, you look at EPS, profitability of AMD is down. Okay, look here it had a better EPS. NVIDIA picked up and now is even higher. Okay, and same thing. The trend here is nice. You know, like you see there is a trend. You see there is something going on. Even if you have no idea what they do, okay, of course you should. But I'm just saying, even if you don't have any idea, just this data speaks for itself. Okay. And same with PE. Look at PE, look at AMD PE, it was flying to the moon. When NVIDIA went up, everyone bought AMD, and AMD earnings were not going up. Only NVIDIA was going up. So NVIDIA was making money, and the stock price went up. Okay, here. AMD was not making money, but the stock price went up and the PE went to the moon because people thought AMD is like NVIDIA. So that's it. So all you had to do is buy NVIDIA and short AMD. And that's how you made money with zero cash. You come with zero money. You just do a, well, anyways, let's just say all you had to do is buy NVIDIA. And so on, so on. So here we looked at revenues, we looked at EPS, we looked at PE, but you can do the same with short interest. You can compare ownership data, understand which one is more volatile. I know based on your preferences, you know, like you don't have to buy institutions. You can buy retail, understand that it's better for short term. Because if you buy heavy retail for long term, anyways, you should ask yourself why institutions are not holding it. So you compare with the biggest, you can compare with same size, and you can compare then with all competitors. So here we saw when you tap the compare button, this pops up for AMD. You see all the competitors, and here it's sorted by valuation. Okay, but you can also sort, and so you can scroll down and you can look at other companies. But then you can also sort by PE. Okay, and see ARM is the first. ARM is so overvalued. And I will tell you why it's overrated, because there is no growth in financials. But again, PE, you need to check the growth. And so you can compare, you can sort by PE. Okay, see like NVIDIA has like a 40, 50 PE. Everything else has high PE, and the growth is not even as big. You can compare also the forecasted growth. If you don't know, just ask me. And And something you can scroll down, see, you can see TSM has low PE. Well, TSM it's a bit special because they don't design the chips, they manufacture them. So you need to understand also the small subtleties, but it doesn't really matter. Everyone is an expert in something, but just having the understanding how you can leverage this data to get a first impression, and then this you can do it very quick. You just compare the graphs. It takes like 5 minutes. Okay, and then you can compare momentum. You can select a different time horizon. Okay, so here you can select 1 year, and you can see how the stock price changed over time. It's very powerful, this thing. And you can even select what you compare it to. So you can check momentum, check how the net income is moving, and check what happened in the stock price. And you can do it for many things. So actually, this is very powerful, and I use it often, especially to find stocks that could get short squeezed, because you can compare financials on different time horizons and sort by short interest. And actually, I should have showed you this, but it's very powerful. I'll keep my secrets for me. I'm joking. Okay, and then you can select peers, and now it's going to be much nicer because you're going to visualize everything. Okay, so when you select peers, the first thing you can look at is the change. You have two things. You have change and scores. Change is you pick one financial, like earnings per share, and you compare the change in earnings per share against the change in stock price. Okay, so here you select earnings per share. Then you can compare for 5 years. Here it's 5 years. You can see how the earnings per share changed over 5 years and how the stock price changed over 5 years. So here is earnings per share, and here is stock price performance. Here is the 5 years that's selected. You can make it 10 years. And see NVIDIA, crazy growth in EPS. And of course, the stock price went up because EPS is going up. It makes sense. It's not overvalued. It makes more money. It's bigger, and you get more value. But you can select other metrics as well. All the metrics that we've talked about. Revenues, net income, PE, etc. Compare them. Compare the change in EPS with the change in stock price. Sometimes you find things. I look at it often. And so this is how to compare the one metric change with the stock price change. But another thing you often want to do is simply compare the metric against another metric. Not the change, the actual metric. Okay? And this is when you want to compare the scores. Okay? Again, why are we doing this? We're doing this to understand what's the best company to buy. Okay? So anytime you think, oh, my friend told me I should buy this, wait, is there a better company? Is there a better competitor I should buy? Boom, I go there and I check. So compare score. A nice one is valuation against PE. Okay, so you compare how big is the company against, or it could be growth against PE, actually, even nicer, but let's go valuation against PE. Against the price to earnings. So how expensive is the stock compared to how much net income the company generates. And so what do you see? Do you see that ARM is a small company with crazy PE? Okay, it's the green one. In pink, AVGO, and in blue, NVIDIA. NVIDIA is big and has a low PE. People know about it. It's big. It still has growth, and actually even growth bigger than its competitors. And yet people are scared. It's undervalued. It's undervalued, huh? But don't tell me again. They have short-term signals and you have long-term. Okay, so this is long-term valuation. Okay, short-term is the signals we talked about in the other videos, and everything comes together. You have the trader who thinks only short-term and execution. You have the investor who thinks long-term and valuation. Me, I was a trader and I was also an investor in different companies, actually. But anyways, I moved a lot. Now I'm here. I don't know what I'm doing. but yeah, it's nice. I'm addicted to this. It's like a game. It's like a game, okay? Like you're going to see. It's super addictive, huh? Super addictive. Like when you make, it's so addictive, especially making money. Anyways, let's focus on this. So you can remove arm and it helps you zoom in. Okay, you just click on this eye. and you compare something P valuation. You can select NVIDIA, you remove it. Now see the blue went away, you zoomed in. Okay, so you can play with it. So recap, what did we do? We said, the first thing you need to do is segment your market. Understand what are the peers in terms of size, in terms of industry. And this, you don't need to think about it too much. You just go in the app, you search for your stock, and you tap compare. Okay. Either tap compare or select peers. Okay. So the peers is when is here. The data was here, the peers is here. This is trading virtual money to play with it. Then you have the financial metrics we talked about. Okay. And then you have the competition analysis we talked about. So you compare with the biggest competitor, and then you compare with the same size. And then you have the next. So this is two graphs. When you have two stocks, when we compared the graphs here, okay. This you can compare two together, and then you have this. When you compare everything together, here you have them all here. Here you have all the semiconductors on only one graph. And you can do it with any other company. You can pick McDonald's and you will see all the competitors. You will see Burger King, Starbucks, everything on only one graph. So it's very nice and easy. And then, so this is the last part, all competitors, okay? And for all competitors, we said you have two things. You have compare growth in 3D, okay? So you pick your time horizon in 4D actually. Anyways, you see the company size and you compare the change in one financial like EPS against the change in stock price. Okay, so EPS change against stock price change for all the companies, all the competitors. And then the last one is you don't compare the change of financial against the change in stock price, you compare the financial against another one for all the companies. So you just pick one stock, the one you thought of buying, and the app will take care of dropping all the competitors. And then you can visualize using the examples I showed you, just EPS against stock price and just PE against valuation to start with. And so this will help you find the best competitor. Just like we saw NVIDIA pop, you will often find others pop as well. You can analyze. Okay, you see ARM is super expensive. You saw AMD. You saw AMD long term is overvalued. Okay, I showed you. Now you can tell me, oh, some fund just bought it, or some insiders are buying, and it's going to go up. Oh, it went up. Yeah, this is a short-term signal. This is not valuation. Okay, this is what we said about this graph. Okay, you have the short-term signals that drive. It's not because it's here that it's not going to go up. It can if you have a good short-term signal. Okay. And again, we have everything. Just ask me. But you have the valuation. Okay, so AMD now is in this zone, and it was in this zone, and I think it's still in this zone, like we saw. Anyways, but doesn't mean it can go up with short term. But this is valuation. This is what Warren Buffett does. But he does it a bit. It goes more than that. Okay, guys. So that's it. I hope you enjoyed the video. Please, if you have questions, feel free to ask. And this deck, I'm going to show it. And please, I'm being asked by, not my boss, but he's acting like my boss, to ask you to please leave reviews on the App Store and on Trustpilot, because it makes a big difference. It helps a lot. We have over 150,000 people who are using the app, and we have about 2,000 reviews. So it's like not even... it's like 1.5%. Anyways, it's not a lot. And I think it's totally fine because it's the same with other apps, but we've compared and all. And well, anyways, and I know that most people haven't never left a review or anything, but it helps a lot and it makes a difference. So thanks a lot and speak soon, guys. The next video, I'm going to cover option risk management. So we're going to level up a bit fast. But remember, again, you had all the signals part, short term and long term. what kind of signals can drive short-term and long-term interest. This helps you time some trades. And we're going to go even beyond that with the trading volume and things like this. But for now, let's focus on that. And then you have this. This is valuation. Okay, this is what company is the best. Is the company undervalued or not? Things like that. And this is for long term. Okay, so this you DCA, you hold, you try to time short term with long term. In the app, all the short term signals come with a long term view. This is not because we don't want you to make money on other opportunities. This is because we're a lot of people and we need to protect the most vulnerable. If someone comes with no experience and buys something and he gets trapped in a hype or doesn't time it well, we want to make sure that no matter what, he's going to make money at some point if he simply waits. Okay? So you're not going to have short-term signals on everything. You're going to have only short-term signals on stocks with the positive long-term view. And something we haven't covered here is the industry view, things like that. So here we talked about the market segmentation and how to pick the best one among peers. But the real thing also to do is understand what industry you want to invest in. Okay, and this today we have a preference for tech and things like this. But we have everything. Like if you look in the app, and that's what we do. We diversify allocations with the preference to growth. And this I covered it also in the investment style and industries. What kind of portfolios and how much you want to allocate into each. But this is important because you really want to invest a bit in everything. Like I know if you don't want to, it's fine. But follow the guidelines and don't worry, because I know everyone wants tech, but don't worry, we're like 50-60% tech. It's more than enough. Okay, you don't need 100% tech. Okay, but again, ultimately you make your own decision and it's fine, you know, because some people have a big portfolio. When your portfolio is 3 years worth of savings, you're not going to put it only in tech. Okay, but if your portfolio is like 2 months worth of savings, okay, go all in tech. Who cares? It's only 2 months worth of savings. If your portfolio is your net worth, well, that's big, you know, like you don't want to go only tech. Especially if you don't own any real estate. Maybe you want to buy some dividend stocks, some real estate stocks, some stability. And then you go here, you check what's the best real estate stock using this. But if you are but if your portfolio is only 5% of your net worth, and you own three flats, okay, me, I love going AI, I love going tech. You want to take some risk with your stocks, you know, and you want to follow these kind of things. So it depends on what you own, how much you invested. It depends on a lot of things. But often, I have to say it. Like I know me, I love stocks and everything, and I know everyone has different preferences. Remember that when you buy flat, okay, you don't look at the price every day, and you hold 10 years. You hold, and you don't care. It's not even liquid. So even if you want it to sell, and that's why it doesn't move as much, it's not liquid. It barely sells and moves. When you buy a stock, it moves every day. It's super liquid. You can trade it from your phone. So of course you have flows. Of course it goes up and goes down. Of course it does. But when you're a beginner and you come and it goes down, you look at it and you think, should I sell? When you buy a house, do you think, should I sell? No, you don't think that. When you buy a house, you hold your house. You don't even look at the price. You don't even look at it. You just think, I'm sitting in my house. But when you buy a stock, you look at it every day. And as soon as it goes down, you think, should I sell or not? But when it's up, you think, oh, it's up, I made money, I'm feeling good. So it's too easy for a beginner to start with stocks and to lose money by selling low, by looking at it every day. And they feel safe with the house. But why don't you just feel safe with your stocks? Tell yourself, I'm going to hold it 10 years. All these good stocks, if you hold them 10 years, if you buy NVIDIA now and hold it 10 years, okay, still diversify, okay, there is always a risk, whatever, but you have the same risk with your house, okay? This house, when you buy a house, you don't know what's going to happen in 10 years. You don't know. It's always going up. Okay, but look, if you had bought gold instead of a house, you would have made more money on any time horizon. Why don't you just buy gold? Why are you buying a house? Just buy gold. You'll make more money. It will pay you better yields, everything. Same with stocks, okay? When you buy a house, here, what am I buying? I'm buying the floor, okay? I'm standing on the floor, okay? When you buy a stock, you put money in engineers who are working hard and who are bringing value to the society, okay? This will always go up more, always, because the floor is not working, okay? The floor, I can find you more floor. When tech comes, at some point, people that are going to start working from home, they're going to live in other places, you'll have better commute, everything, okay? The floor will never go up as fast as stocks, okay? All you have to do is pick a business that's good. How? Look at this, revenues, everything. If you don't know how to do it, ask me, okay? I can find you a lot of stocks that will keep going up, and I'm doing great with stocks, okay? And a lot of people have been doing great. The only thing, I'm talking for beginners. I know that, a lot of people already know this, but if you're a beginner, you have to understand that when you buy a house, you don't care. You just buy it, you feel safe, and you don't even think about selling it. I don't know anyone who bought his first house and who thought 1 month after, should I sell it? Let me check the market price. Okay? And even if it does, you're locked in. You're locked in. You pay 5%, 6% fee with the government twice. You lost 12% just in the transaction. With the stocks, you don't have that. You're not losing 12% in your transaction. Okay? With the stocks, you don't think every day, should I sell it? You don't even look at it. The stocks are more liquid, so it moves more. Anyways, so valuation matters. It matters long term. And valuation is so powerful that if you follow it, if you don't even care about owning, really, always own some, of course, like I'm not saying don't. If you don't, again, buy dividend, etc., you need to feel safe. But if you have money you don't need, this is super powerful. Okay. Remember, hold. When you value Warren Buffett, he doesn't think every day, should I sell? He holds it. Warren Buffett, he doesn't come and drops all the money in one go and exits in one go. Okay? Warren Buffett, he GCA. He enters slowly, he goes out slowly, and he thinks long term. He knows that stocks are better than properties and real estate. But you get scared. You look every day and you sell if it's down. You ask yourself, should I sell every day? But your house, you're not asking yourself. Trust me, if you could buy and sell a house like this with no fee, instantly, super easily, and if you thought every day, should I sell or not, you would have the same risk as stocks. Okay? The stocks, the real risk is you. You are the risk. You're the risk because if you don't understand, you're going to do all the mistakes. Again, there is short-term signals and long-term, but this comes with this long-term view. Okay, I've said enough. So I hope I didn't scare you. I hope I scared those those who are starting, and I want them to understand that this is super important. Like valuation is 101, at least revenues, net income, and all the rest. Again, don't get don't be this guy. Don't be this guy who gets scared and who needs to look at everything, okay? And don't be this guy who just doesn't care. And this framework is a nice framework in between both, where you get to have a quick view and you don't need to go too much in the details. Okay? Allez, speak soon. Bye bye. Like, follow, and everything. Cheers. Okay.